Hey everybody, welcome to Options with Hans. I am Hans Albrecht, of course. 15 years as a pro options market maker, another decade after that running a whole bunch of income funds, ETFs, downside protect funds, $1 billion managed in option strategies over 3 decades. So, as always, it is your trade, it is your responsibility. And if you're okay with that, let's keep going. Okay, so today we're talking about Alphabet. Big news. They just announced major AI commerce partnerships with Walmart, Shopify, Target, and a couple more companies. Very important developments this weekend as we see the saga of Google unfold over time in a very favorable way for them. And this company is acting like a startup, not that big company it was about a year ago. It didn't seem to know what it was doing, just kind of sitting back on its former success, its extremely strong position in search. It is absolutely starting to kill it. Every time I turn around, I see another amazing tool. There's one in Gemini today that I saw. It'll teach you anything. It's a sort of learning mode. And you put anything into it and it'll turn it into a course. It'll give you quizzes. It will not move on until you're ready to move on to the next step. I mean, this is going to revolutionize education for people around the world who can't have access to quality education. News this weekend matters for a number of different reasons. So it's trust, right? So companies want to align themselves with companies that they can trust. And Google is that company, as opposed to maybe an open AI that is an up and comer. Of course, it's the brand name that everybody knows for GPTing things, but it is very much still the up and comer. It needs a lot of money to do things. It may cut corners here and there. It doesn't have that established presence that Google has developed over decades. It's a great example of how that trust is starting to play out as people realize that more of their processes are going to have to be done with AI, agentic AI in the cloud, et cetera, et cetera. Here's Google sitting right there with all the tools and the history to back it up. So I think they're going to really crush it on this front in 2026. Now, I want to be clear up front. I've been very bullish on this thing for about 50% of this last move. So from about 210 to 220. Nothing material has really changed in my view. The stock is more expensive than it was, no question, but that alone doesn't really end this story. Nvidia was expensive all the way up too. Remember, earnings keep forcing repeated re-ratings when something is very, very strong. I'm not saying it's on that same trajectory as Nvidia was, but remember, you can be wrong calling the top on these things. If you're just looking at what you're seeing right in front of you, you've got to look way ahead and appreciate the position that Google is in. The reason I'm still bullish is still simple. Google is the most powerful and durable vertical AI stack in the world, period. When you step back, you ask which company is most likely to be around in 20 or 30 years. Google is far more likely than anybody else, even maybe Nvidia, because Google is embedded in everything. We don't just use Google's products. We live inside Google's world, right? We're just renters inside Google's world. And today I want to explain why this isn't just sort of an AI hype story. It's a margin story. It's a cost story, a valuation re-rating story. And more importantly, it's an AI ROI story. And that's really showing up already. It's not showing up 5 years from now. And that's a really big difference in a market where investors are suddenly very sensitive to ROI. So we're going to take another look at the Turbo Trader scanner as well, because inside the program, we've actually sized up our Google position last week. It's been calling for both income and turbo trades. Remember, you get yellow is a bit more incomey, green is strong income, but also turbo trades grabbing that extra upside. I'll show you some results there. You're not going to want to miss that. So let's dig in. Number one, data and YouTube. Google has something no other company has, 25 years of real behavioral data from literally everything. I remember at some point they cut down on the cookies, the third-party arrangements that Google had with other people. Basically, Google at one point essentially followed you around to basically about 75% of everywhere you went on the internet. I mean, they literally are everywhere. And as a result, they don't just know what we ask for, what we search for. They know what we watch. They know how we move. They know what we buy. They know how our behavior changes over time. And I'd wager to say that they're starting to know us probably a little better than we know ourselves. And then YouTube, which I've called the greatest asset on earth for years, is quietly one of the most valuable visual and physical world AI trading data sets ever created, right? As AI moves out of text and into that physical world, think of it, robotics and vision and autonomy, Internet of Things, sensors everywhere. That matters a lot, right? And you're seeing Gemini already assesses visuals better than GPT. GPT can't even do some things like that. The newest multimodal models, including what I'm going to call the nano banana moment, are these real inflection points. This is one of those moments in the last few weeks to 2 months where people have gone, uh-oh, this is really special, along with Gemini 3. So, and what that means is more AI content means also more YouTube content. More YouTube content means engagement. More engagement means more ads. It's a self-reinforcing loop. A little bit of in the right place at the right time. I mean, they picked up YouTube all those years ago, one of the greatest purchases ever. And now as we create endless amounts of content, boom, there it is, going right onto YouTube. Next, interface and commerce. Okay, so this is where the Google story really separates from the rest. So everybody wants to talk about models, these bigger models, these better models, these faster models. Models don't matter if you don't own the interface. So Alphabet owns more user interfaces than anyone on the planet. Search, Chrome, Android, Gmail, Maps, YouTube, Workspace, more. There are apps that you have embedded into your life, right? These aren't apps that you check once in a blue moon, once a month, you sign up for, and they consider you a user, even though you haven't looked at it in 2 years. These are default behaviors. These are habits. These are where agentic AI becomes very, very powerful. We're not talking about a chat window, but embedded directly into how everyone lives and works and searches and navigates and shops and creates. It's everywhere, right? Google doesn't need to convince users to change behavior. They are able to just upgrade the experience, right? So think of the productivity suite within Google. You have a suite that people use, you just improve it, you instill it with incredible insight abilities from AI. Then you have pricing power. Microsoft has something very, very similar in that respect. So search, in this case, we see from this decision they made this weekend, search is becoming an agent. This is very, very clever. Google, Gmail becomes an agent. Maps become an AI agent. Workspace becomes an agent, right? Now what you do is you layer commerce on top of that. So when Walmart, Shopify, Target, Etsy choose Google, they're not just choosing a model, they're choosing distribution, they're choosing trust, they're choosing access to intent, right? This is that key word there, intent. Google's not just guessing what you might want someday. It sees what you want right now. You can search, discover, and buy without even leaving Search or Gemini anymore. Google is turning AI into the front door for retail commerce, in a sense, with what we're seeing here, and certainly the very beginnings of that. Google doesn't need to own the store. It owns the roads, the signs, the traffic lights, and it's going to charge everybody to be in their little ecosystem of infrastructure there. That keeps users inside the Google ecosystem. It preserves that search traffic, right? 2.7 billion daily search visits that drive its ad monopoly. It's a problem, right? The blue check under threat. They had to figure something out. And this is amazing. And this is why margins are very, very important. So next, compute economics, TPUs. Okay, so this is the part that really, really gets me excited. This separates Google from everyone else in terms of the cost. Compute economics. Google's 7th generation TPU, we call it Ironwood, delivers major performance improvements. And because that matters, because AI is shifting from training to inference, right? Inference. You're sick of hearing that word from me. It's an operating cost game, right? Inference, the gears never stop turning. It is a massive amount of compute. It's a massive amount of tokens. Google's now suddenly like 90 trillion tokens, like 10 times the tokens being used than only 1 year ago. 10 times. They are doing massive, massive business in the compute business, and that's expensive, right? So when you think of Microsoft, OpenAI, Meta, a huge portion of every CapEx dollar they spend flows straight to NVIDIA, AMD at those prices, right? Retail-ish prices, maybe wholesale a little bit, but very, very expensive. That's going to cap margins. Google runs Gemini on internal silicon. That means the marginal cost, because they make these things, or they design and essentially make them, that means the marginal cost of an AI search query trends towards zero faster than Bing or ChatGPT, which are shackled to that commercial GPU pricing. Lower costs lets Google deploy better AI across search, across YouTube, Gmail, Docs without destroying margins. In fact, Google has the ability to destroy other people by driving down the cost of everything because they can do things more cheaply. That is the compute flywheel, and it flows directly into margins. This is an incredible benefit in a world that is changing, but you are sprinting in this new world. Companies are sprinting. A little improvement, a marginal improvement on anything makes a difference, let alone a massive one like this. And that's being able to deliver compute for less. Number 4, data, gravity, and energy. Data, gravity, and energy. Lower costs lets Google process 1.3 quadrillion tokens per month. That is up 20 times year over year. Excuse me, I thought it was 10. It's 20 times year over year. More tokens mean more data means better models make TPUs even more efficient. That's called data gravity. Google's monetizing that, right? Anthropic alone is using over 1 million TPUs. Infrastructure isn't just a cost anymore, right? It's a high margin revenue source. Now you add energy with nuclear deals. There's Suncatcher. Google is vertically integrating energy and silicon and the model and the product and this sort of gateway to commerce. Wall Street is still treating Google a little bit like CapEx, right? That like CapEx is a drag for them. In reality, what Google is doing is it is buying deflationary assets. Deflationary assets. This is an absolute advantage that nobody else has. And this is why Google probably still has to re-rate. It probably still has room for re-rating. I had a 325 target back when it was 240 or 230, and now it's there. As TPU margins show up, Google shouldn't really trade like an old ad company. I know the margin, I know the multiple has increased, but this thing needs to be trading like hard tech infrastructure on an AI adjusted multiple. 29 to 32, 33 earnings by 2026, I think is a reasonable place to put it. And with earnings where they are, I'd say we could be looking at $400 plus to $450 with upside into 2027 as margins expand, as buybacks kick in, as the story remains strong. I said 6 months ago that Google was in a phase where every dollar of CapEx is worth it. That hasn't changed. Think of how that's different from Meta right now. And you have two companies in the communication sector that are on completely different trajectories. This is a special moment. Okay, now let's take a look at some of these interesting things, these trades. Okay, so here's the TurboTrader Pro scanner, which is part of the TurboTrader program. And you've got this filtering thousands and thousands of stocks, finding these unique opportunities that are the best setups for green, which is turbos, which is really playing for that upside. The yellows, which are income, very incomey right now. So you've got the Seagate, which was green for a long, long time. We had a couple members make money on Seagate, on Western Digital, was in the scanner. They did some nice trades on those. Now those are kind of stalling out just a little bit. We've got more income trades down here. You can see consumer discretionary in there. We've got financials, of course, which have been acting well. Materials, naturally. We've got gold stocks in there as well. A little bit of information technology, which is good to see, even though it's a little bit, we've got a bit of bearish on the information technology side of things, which is unusual to see, right? After so many years of tech being amazing. I mean, it's still going to be amazing, but we do have a little bit of a rotation going on out there. We can see the trend. We've actually got a new feature coming in that's going to be another column giving you a better idea of the trend, even better durable idea. But you can see here, Freeport, for example, Copper Play, we made good money on those in Leaps Trader. And you can see it's a very solid green at this point. You can see Seagate has been a downgrade. So the direction of the trend, which is also predicated on the alpha momentum sector. So you can kind of see what areas, thematic sorts of things are going on here. Again, pulling in all kinds of data, big money flows and skew and you name it, term structure, all that stuff. Healthcare acting quite well, just downgrading a little bit on Friday versus the day before, but very solid, I have to say. There was a time not long ago where we had a lot of red everywhere because it was really a very concentrated market, a lot of red except for information technology. And, really it was all about tech and pure AI. Now we're seeing that broadening out. Here's your breadth balance, which is looking at some unique metrics, very, very solid, as well as the longer term trend here. Materials confirming that as well, of course, although, there's materials, there's gold, and then, even within sectors, you've got to be aware of what looks interesting in there, right? Like consumer discretionary, or communication rather. That's Alphabet and Meta, right? As we just talked about, two very, very different stocks, but playing into that particular sector. Energy just can't get going. I don't like trading energy, and so I'm all too happy to see it in red. I do not want to really trade it right now. I don't think oil is really going up very far. Consumer staples. This is interesting. Look, we had some positive moves in there, and it's kind of turned a little bit sour. Let's see, because I did a video for members earlier today, and I talked about how there's like a bit of optimism there in that consumer staples area from Goldman Sachs, and I went through a bit of the reasoning as to why I kind of thought that was really interesting based on some option pricing that we were seeing. Very, very kind of interesting, and certainly arguing for the possibility that the market may be underestimating this year, underestimating certain areas like that, because in a similar way that they underestimated some areas like Google and Micron, where the market's really going to get a lot of things wrong in this very rapidly changing world, and so we're going to have these re-rating opportunities. So that's really what I talked about quite a bit in there. But you can see the more speculative areas, my squeeze ratio, which is really the animal spirits, nothing going on there. 0, 0, 0. We've got our future medicine, not much happening there. I do have quite a few positions in there. I'm quite optimistic in a couple of areas of the genomics and biotech area, but because I think healthcare is going to ultimately do very, very well. We see healthcare has been very, very solid over the last little while. So we can see here some income trades. Now, the whole point of it is just to show you this little bit. We've got the major risk gauges up here, still looking very, very fine. Google, of course, right down the middle. So it is about to turn green again. I know that. So it was green for a little while. It went yellow, and we actually have an income as well as a turbo trade. So they're both doing great, but the turbo trade is really starting to kick in. So that's what this is all about, right? It's about and I managed hundreds of millions of dollars in the $750 million worth of these income ETFs, cover call ETFs, downside protect ETFs as well. But, income ETFs being a real focus for me. I generated $750 million for investors around the world doing this sort of thing. And really one of the things that I always sort of pushed back on with management was they wanted more income. And I said, listen, you've got to be sensible about this. So when I built this scanner with 3 decades of what goes on in my mind and all the things that I learned as a volatility arbitrageur, pro options market maker on the old floor for 15 years, I learned option pricing. I learned risk reward, because there is a risk in going for income when there's upside, right? You're in the market, you're taking risk. You're in risk markets because you want to take some risk. You don't want to give away all the upside and merely retain most of the downside. That is not a great outlook if you really think about it. So you really have to position yourself to take advantage of the upside. And that's exactly what we're doing in Alphabet, our portfolio. We also have Goldman Sachs, which we just closed the other day. We had a really good run there. That was another turbo. So you want to position yourself. Income is that wonderful base foundation for a portfolio, an options portfolio that really takes advantage of that cash flow. But when that strategic greed kicks in, you really want to be able to have another strategy available to you, but only sensible, right? You need to be greedy when it makes sense. There's no guarantee of anything. You could get greedy and put on a fantastic trade and things turn around. We know markets are going to market, but the more you concentrate on better setups and, just as important, staying away from bad setups, staying away from the temptation, the nonsense, the noise that you're hearing every day, the more you keep yourself out of bad situations, the better your results are going to be overall by far. That is 100%. I've had so many people, students come to me over the years, mentoring students, saying, I can make money. I just give it all back and more. And that is really an underappreciated part of this particular business, is that it can really be easy at times, but it's almost easier to really give it all back and more. And so really it is about stepping in as few piles of you know what as possible. Okay, guys. So anyway, if you are interested in the Turbo program, check it out down in the description. I'll try to put some information down in there, but there are lots of videos about it as well. Check it out. We'd love to have you. It includes weekly classes, it's education, it's following what I'm doing, my portfolio. You get everything, 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 courses, you name it. It is really one of the most amazing, unique things out there. And we're really thrilled to be putting it on. And we've got a great team to support you and provide that customer service that you deserve. And that's it. And I hope you guys have a wonderful rest of the evening. It is Sunday night, and we've got a big week coming up ahead. Quite a bit of data again, and of course, stocks near all-time highs. So let's see what happens. Let's see. I'm curious to see what happens on the small cap side of things as well, and the mid cap. So take care, everybody, and we'll see you soon.